Hello and welcome to the Global View on this Tuesday, Christmas Eve. I'm Andrew Gagan. Thanks for joining us here at AusBiz. Let's check what happened overnight. Global equities mostly higher on Wall Street. The majors there rising in thin holiday trading. Mega cap growth stocks led the gains with Meta, Nvidia and Tesla, the best performers, while Alphabet and Amazon slipped. And the US chip makers rose on the prospect of increased tariffs on Chinese chip makers. I'll get to that in just a moment. Qualcomm shares rose after a court found its central processors are properly licensed under agreement with UK-based ARM Holdings. ARM vowing to seek a fresh trial there, its shares falling. Eli Lilly gained after the US Food and Drug Administration approved the drug maker's weight loss treatment Zepbound for obstructive sleep apnea. And US-listed shares of sleep apnea device maker ResMed fell in response. In fact, it shows it actually rose, but nonetheless, Nordstrom shares fell after the department store founding family agreed to take the company private, and Walmart shares lost ground after the US consumer finance regulator accused the retailer and workforce payments company Branch Messenger of forcing more than 1 million delivery drivers into using accounts that cost them more than $10 million in junk fees. Well, the Biden administration has launched a trade investigation into Chinese-made semiconductors that could lead to increased US tariffs on chips from China. President Biden has already imposed a 50% tariff on Chinese semiconductors that starts on January 1st, while also tightening export curbs on AI and memory chips and chip-making equipment. China's Commerce Ministry has said that the US chip probe was protectionist and would hurt American firms and disrupt the global chip supply chain, and that Beijing would take all necessary measures to firmly defend its rights and interests. An incoming President Donald Trump has warned that he'll impose 60% tariffs on Chinese imports. And the latest US data shows consumer confidence unexpectedly weakened in December as the post-election euphoria dissipated, and new orders for US manufactured capital goods surged 0.7% in November amid strong demand for machinery and electrical products. Meanwhile, US Treasury yields rose before the sale of $69 billion in two-year Treasury notes, which meant healthy demand despite the holiday period. And elsewhere, the US dollar has rebounded while the euro dipped, and the Aussie is at 62.5 US cents. And Bitcoin has weakened further. It's currently around 94,500 US dollars. Oil prices, they're slightly weaker in thin trade ahead of the Christmas holiday, amid concerns about a supply surplus next year and strong US dollar. Brent crude futures down around 0.5% at $72 a barrel. The gold price edged lower, weighed down by the US dollar and higher Treasury yield. Spot gold at $2,609 an ounce. Copper's little change, and iron ore slightly weaker at $103 US a ton. So let's head to the States, see what's moving markets there. Steve Sosnick is joining us from Interactive Brokers. Steve, welcome. Good to see you there. Interested to get your view on what you're seeing in the markets. Obviously, it is thin. We're in that holiday period. Certainly very much the case here. Trying to find anyone in the city at the moment. We take an early mark here in Australia. But let's go back to Friday and what you saw just in terms of that, the movement there, and I guess the momentum and FOMO is still very much at play.
Yeah, great to see you again, Andrew. Thank you so much for having me. And it's right now, what we saw on Friday and what we saw today was a continuation of it. You know, we were definitely shocked on Wednesday by the fall that we had, and I think that there was a reassessment of risk, certainly on Wednesday, and that persisted, I should say, on Thursday. But then on Friday, the buy the dip people said, okay, let's come back in. There's always if there's a dip, therefore it must be bought. And they did. The rally did fade a bit into the end of the day. Some technical reasons for that because of options expiration and because of the Nasdaq rebalance. Coincidentally, the three stocks that had their weights reduced in the Nasdaq 100, because there's some funny technicalities about why they have to cap certain market weights. Those three stocks were Broadcom, Tesla, and Meta. Coincidentally, the three biggest gainers today were Broadcom, Tesla, Meta. So there was a bit of a sell-off into the close as the indexers had to sell them on Friday. People saw that as a buying opportunity. They took them higher. and with the lack of real selling pressure, off we went.
So, Steve, what do you make of then the Santa Claus rally? Has he already been and gone? Is he not coming? I see you're referring it to perhaps the Rudolph rally.
Yeah. I called it the Rudolph rally because we were just, they were just sort of, following the Mag Sevens through the murk. And that's the Rudolph the Red-Nosed Reindeer effect on that they have, and that's really what we've been seeing recently. It's basically when you separate out the performance between the Nasdaq 100, the S&P, and then an equal weighted version of the S&P. It's obvious that it's been tech driving the bus all the way. We had this sort of righteous broadening, I guess, for lack of a better word, that persisted for a good portion of the third and fourth quarters. But that's really come to an end as we get into real performance chasing at year end, and that's why it's foggy, it's murky out there, but the Mag 7 are like Rudolph with that the sleigh can follow.
Now, Steve, of course, we're looking ahead to the new year and the incoming Trump administration, and well, as it turns out, you've been mixing it with the movers and shakers in the forthcoming administration. In particular, Stephen Miron, who is been appointed chair of the Council of Economic Advisors. Tell us the backstory.
Yeah, I mean, every so often a blind chicken picks up a piece of corn, right? Basically, my colleague Jose Torres, our senior economist, was at a conference and met Nouriel Roubini and Stephen Miron. They're actually They were partners in a venture as well, and basically. Dr. Miron, they both collaborated on a paper basically saying that the Treasury Department, through their mix of funding on the short end rather than the long end, was sort of artificially suppressing Treasury rates. And so they consented to do a podcast with us. I got to admit, I didn't arrange it, but it was nice to be invited to it. And, I got to ask some questions. I got to meet both of them. Dr. Roubini is less doomy and gloomy when you talk to him in person. And Dr. Miron, it'll be interesting to see. And I wonder if that's one of the reasons why rates rose today, because if he feels that the Treasury has been artificially, sort of depressing borrowing rates, that thinking may get back into the Treasury. And I have a feeling he'll have a sympathetic ear from Scott Bessent, the incoming Treasury Secretary, whom I have not met. But I think this is going to be a very interesting one. So if you go to IBKR podcasts and search for Miron or Roubini, you'll be able to listen to it.
All right, great, worth a listen. Absolutely, we'll head to that. So, what does that tell you, though? I guess, given those nominations of Donald Trump, how are that shaping up in terms of, or how it's shaping potential fiscal policies?
Well, I mean, I think the biggest issue here is, the unelected co-president that we have, and that really threw a monkey wrench into the budget negotiations that we had, the ongoing continuing resolution to keep the government open. There was a deal earlier last week. The deadline was Friday night, midnight. It seemed to be a bipartisan deal. Then Elon Musk weighed in, and then Donald Trump followed, and the deal was broken. And then after a couple of fits and starts, we ended up essentially with the same deal that we didn't have in the first place, although with some things taken out of it. Arguably, there's some people who say that some China stuff that might have hurt Elon Musk's ventures in China was removed, but I'm not going to get into the politics of it. What I am going to get into is the fact that it points out that the Republicans are going to have a very, very fragile majority in Congress in the incoming Congress. It's going to be smaller than it was when the vote was taken. If coincidentally, the majority turned out to be smaller than it was because a congresswoman in Texas was admitted to memory care 6 months ago and no one noticed, so she hadn't been voting. So it's a very dysfunctional situation right now. And I think with a very narrow majority, I should say, and sort of inability to really get everybody on the same page, with some very well-known people firing in opinions from the sides. It's going to be an interesting political environment going forward. And while I think some of the aspects of deregulation that the market's banking on will probably get in, tariffs can be done by executive order. Some other things can be done by executive order, but I think some big legislation that the market might be hoping for, particularly on the tax side, might be tougher sledding than we think.
So, Steve, what do you do as an investor? Do you stay the course until inauguration on January 20th?
I think until inauguration, there's probably not a lot of catalysts. My mantra all along has been, don't fight the tape, but insure against it. And that certainly, that insurance paid off a bit on Wednesday. I think we're going to get into a more volatile period because, as we've discussed before, the inauguration's January 20th. That happens to be a market holiday here. And what we also get into immediately after is earnings season. And it's an earnings season with very high expectations priced in. Double-digit earnings growth, 15% more or less earnings growth priced in for the S&P 500. So if there's any whiff of uncertainty, whether it's fiscal policy, whether it's just the ongoing state of the economy, if there's any whiff that guidance won't be met, we've seen how certain companies get punished when they can't meet their guidance. Think about Micron Technologies a week ago, and so this is really going to be the key. I think I think right now, particularly the next week or two. You know what? In Australia, enjoy your summer. I'm assuming you have better weather here than where it snowed. It's been snowing every day, but it's I think going to be a little bit murky until middle to late January. But then I think you may want to be prepared for some turbulence going into that.
Yeah. Okay. Well, enjoy the holidays and then take a deep breath, and we'll wait for that volatility that Donald Trump will bring. Steve, it has been terrific to get your views and analysis across the year. Enjoy your holidays, and we look forward to doing it all again in the new year. Thanks for joining us from Interactive Brokers.
Thank you so much. See you in 25.
Steve Sosnick from Interactive Brokers. Let's quickly check where we're likely to open. In fact, we just flipped because we had been negative on SPY futures, but looking for a relatively flat opening, perhaps some positivity emerging there. We'll get right across it when we get underway in just a couple of minutes' time.